All right, let's dive into the world of Tarsons Products Limited. They're this Indian company making a name for themselves in the global labware market. You know what, those beakers and petri dishes you see in labs on TV? We're going to be using their Q3 FY25 earnings call transcript, the investor presentation, and the auditor's report to try to understand, how they did recently and what they're planning to do in the future. Almost like we're financial detectives,
Yeah,
piecing together clues, right? To see if this company is really poised to become a global player.
that's a great way to put it. And, the first clue is a big one. Tarsons reported record revenue this quarter, their highest ever for a Q3. They hit 76.2 crores, which is a jump of over 23% compared to the same period last year. And for the first 9 months of the fiscal year, they've already pulled in 221 crores.
Wow, that's pretty impressive. So what's driving this growth? I mean, is this just a case of, a rising tide lifts all boats with the global demand for labware booming, or is there something more to it?
Well, the rising tide definitely helps. Think about all the research happening in life sciences, biotech, healthcare, even vaccine development. All of that requires lab equipment. But, Tarsons isn't just passively riding the wave. They're actively building a bigger, better boat.
Okay, so what's their secret sauce?
Well, one thing they've been doing is strategically expanding their product line, moving into cell culture and bioprocessing products. These are areas with, huge growth potential. And Tarsons is positioning itself to, really capitalize on that.
So they're not content just sticking with the basics. They're really branching out into more specialized areas. And they're not content with just the Indian market either, right? They're making moves to go global.
Absolutely. They've been participating in international trade fairs, building their overseas distribution networks, and really aiming to become a major player on the world stage. One of their key moves has been this new Ponsla plant. It's a brand new manufacturing facility in India.
Yeah, this Ponchla plant seems to be a big part of their strategy. Can you tell us a little bit more about it?
Sure, it's a massive expansion that allows them to, first of all, meet the growing demand for their existing products, but also, crucially, start producing those new cell culture and bioprocessing lines. It's a game changer for their production capacity.
Yeah, but I imagine an expansion that big comes with some pretty significant upfront costs. So how does that impact their profitability?
Yeah, you're right. It's not all smooth sailing. The Ponchla plant, while it's a strategic investment, it does come with costs that are impacting their short-term profitability. We're seeing increased depreciation and interest expenses weighing on their profit margins, at least for now.
Right, so it's kind of like taking out a mortgage on a bigger house. You might have higher monthly payments initially, but you have more space and potential in the long run. It's a gamble, though, isn't it? Betting that future growth will justify those initial costs.
It is a gamble, and a bold one. But Tarsons isn't just throwing money at expansion. They're making calculated moves to secure their place in the global market. Like take their recent acquisition of Nerba. Nerby is a German labware distributor.
Right, the Nerbo acquisition, that seemed like a really strategic power play. So tell us a little more about how that fits into their overall plan.
Well, acquiring Nerbe gives Tarsons direct access to the European market, which is a massive opportunity for growth. But here's where it gets really interesting. The long-term plan is to supply Nerbe with products manufactured in India.
Oh, that's a smart strategy. Leveraging their lower manufacturing costs in India to compete effectively in the European market. Sounds like a pretty well-calculated maneuver.
It does, doesn't it? It suggests a deep understanding of the global landscape and a willingness to make bold moves.
All this talk about global expansion makes me wonder, just how big is the market they're trying to tap into?
Well, the global plastic labware market is valued at a staggering 50,000 crores.
50,000 crores.
Tarsons, even with their impressive growth, is still a relatively small player in this, enormous market.
So they have a lot of room to grow. But with such big ambitions, they must be facing some pretty serious competition, right?
Oh, absolutely. While some opportunistic players have kind of faded post-COVID, the established competitors are a force to be reckoned with. These are the industry giants with established brands, extensive distribution networks, and deep pockets for research and development.
So Tarsons has a real challenge ahead of them. Staying ahead of the curve and differentiating themselves is going to be crucial. What are they doing to make sure they don't get lost in the crowd?
Well, a few things. They're focusing on building their brand, emphasizing their reputation for high-quality products, and investing in automation and technology to improve their efficiency and reduce costs. But it's not just about efficiency. They're also focusing on innovation, developing new products, and even exploring the possibility of moving into benchtop instrumentation, which is a segment currently dominated by some of the biggest names in the industry.
That sounds like a pretty risky move, going head-to-head with the industry giants in a new product category.
It is a risky move, but one with, potentially high rewards. It shows they're not content with just being a consumable supplier. They're aiming to become a comprehensive solutions provider. And that's a much bigger game.
Speaking of big games, the Poncho plant is still in its ramp-up phase. How are they managing that transition, while simultaneously trying to take on the global market?
It's a delicate balancing act. They're dealing with those initial fixed costs of the new plant and the gradual introduction of new product lines, both of which are impacting their profitability in the short term. Their standalone EBITDA margin, which is a measure of core profitability, dipped slightly to 36.7%, and their standalone PAT margin, which reflects their net profit after taxes, is currently around 10%.
Those margins do seem a bit low, especially considering their growth ambitions. Are they concerned about that?
Well, they're aware of the short-term challenges, but they're confident in their long-term strategy. They expect to see those margins rebound. As the Postula plant reaches full capacity and revenue from new products starts to flow in.
Okay, so it's like they're laying the groundwork for a massive leap forward. But are those leaps paying off right now? What do their financials tell us about their current performance?
That's a great question, and one we'll explore in more detail. A little later. We'll delve into the specifics of their revenue breakdown, cash flow, and how they're managing their debt.
Okay, well, we'll come back and uncover those hidden clues and see what the numbers reveal about Tarson's journey to, I guess, global domination.
Exactly. Stay with us.
So welcome back to our deep dive into Tarson's Products Limited. Before we took a break there, we were talking about their ambitious expansion plans and the financial hurdles they're facing. So let's dig into those financials a bit deeper, see what they reveal about Tarson's current performance.
All right, let's examine those financial clues. One interesting detail is the breakdown of their revenue. In the recent quarter, about 55% of their consolidated revenue came from the domestic market, while 45% was from, overseas sales.
Okay, so it's almost like an even split between domestic and international markets. Seems like a good position to be in, not overly reliant on any single market.
Yeah, exactly. And if we look at the 9-month figures, the split shifts slightly, 53% domestic and 47% overseas. This suggests a growing international presence, which, aligns with their overall strategy.
Right. And speaking of their overall strategy, we talked earlier about their EBITDA and PAT margins, but what about their gross profit margin? What can that tell us?
Well, gross profit margin, it's a key indicator of core profitability before you factor in operating expenses and other costs. For Tarsons, their standalone gross profit margin in Q3 was a healthy 71.2%.
That sounds pretty good. How does that compare to, like, the industry average?
It's a very respectable margin, especially considering the competitive landscape. It reflects their ability to, manage input costs and maintain pricing power, even with some pressure in the market.
Right, and we did hear them mention some pricing challenges, especially with the launch of new products. It's a tough balance, right? You need to be competitive on price, but also protect your profitability.
It's a tightrope walk for sure. But they did mention they're getting better realizations on their exports due to the falling rupee, which would help boost those overseas margins.
Right, yeah, makes sense. Currency fluctuations can have a big impact, especially for a company with a growing export business. So, are they generating enough cash to fund these ambitious growth plans?
Well, let's take a look at their cash flow. Their standalone cash PAT for the 9-month period was 63.5 crores, which is a solid increase of 4.9% year on year. This suggests they're generating, healthy cash flow from operations, which is crucial for, reinvesting in the business.
Okay, so that's a positive sign. It seems like they're managing their finances pretty well, but they are taking on debt to fund this expansion, right?
You're right. Their consolidated debt as of December 31st stood at 277.9 crores. They're using a combination of debt and internal cash flow, which is, a pretty common approach for growth-oriented companies.
Right, so they're playing a bit of a balancing act, using debt strategically to accelerate growth, but also managing it carefully to avoid, over-leveraging themselves.
Exactly. And, based on their current performance and projections, it seems like they have a solid financial foundation to support their plans.
Speaking of plans, we talked earlier about their cell culture product line. Can you tell us a little bit more about their specific strategy there?
Yeah, so they're starting with the essentials, like cell culture vessels. These are used in, a variety of research applications. It's a smart move to, build a solid foundation before expanding into more, niche products.
Right, yeah. Start with the basics and then build from there. But what kind of market share are they aiming for with these products?
Well, they're targeting a 25–30% market share in India. Within the next 3 to 4 years, the Indian market for these products is estimated to be around 400 crores. So we're talking potentially, 120 crores in revenue, just from this segment alone.
Wow, that's a a significant chunk of the market. And I imagine their global ambitions for this product line are even bigger.
Oh, absolutely. The global market for cell culture products is much larger. It's estimated at around 6,000 to 7,000 cores. If they can capture a similar market share globally, we're talking about adding another like 1,500, 2,100 cores to their revenue.
Wow. Now, those are some serious numbers, but let's not forget about their existing product lines. Those are still a major part of their business, right?
Oh, of course, Tarsons has a wide range of products with over 1,700 SKUs across 300 product segments. Their core business lies in consumables, things like pipette tips, centrifuge tubes, and petri dishes, which make up about 55% of their current revenue. These are the products they'll likely be leveraging to, supply Nurbe in Europe.
Right, so utilizing their existing manufacturing expertise to tap into new markets sounds like a well thought out strategy. But they're also looking to expand their presence in reusables, aren't they?
Yes, they are. Reusables like bottles, carboys, and beakers currently contribute around 40% of their revenue. They see growth potential there, particularly in India, where plastic reusables are, popular for their durability and cost effectiveness.
It's interesting how they're tailoring their product strategies to meet the specific needs of different markets. It shows they really understand their customer base.
Yeah, and their pencil plant will play a key role in this. They'll be manufacturing their cell culture products there and expanding their capacity in other key areas. It's like they're building this powerhouse for future growth.
So we talked earlier about the competitive landscape. How is Tarsons planning to differentiate themselves from the other players, especially those global giants?
Well, they're emphasizing their brand and their reputation for, high-quality products. They've been in this business for over 40 years, and they've built a strong foundation of loyal customers.
So they're leveraging their history and experience as a key differentiator.
Exactly. They're also focusing on, automation and technology. In their manufacturing processes, their Ponchla plant, for example, is highly automated, which helps them achieve consistent quality, improve efficiency, and reduce costs.
It sounds like they're combining traditional strengths with modern technology to stay ahead of the curve. But can they really compete with the big players in the long run?
Well, that's the million-dollar question, isn't it? The global market for labware is fragmented, with both multinational corporations and smaller regional companies vying for market share. Tarsons will need to, play a smart game to succeed.
So we've talked about their acquisition of Nurbe, giving them, a foothold in Europe. But what about other regions? Do they have plans to expand beyond Europe?
Yeah, they've mentioned an ambitious goal of exporting to around 120 countries in the next 5 to 10 years. They're currently selling their products in over 40 countries, so they're already making progress.
120 countries. That's a truly global ambition. But each region's going to have its own unique challenges and market dynamics, right? So how are they planning to navigate that kind of complexity?
Well, it's a massive undertaking. Each region will have different regulatory requirements, customer preferences, and competitive landscapes. So Tarsons will need to adapt their products, their marketing, their distribution strategies accordingly.
Right. So they can't just replicate their Indian success story in other markets. They'll need to be, flexible and responsive to local nuances.
Exactly. It's about understanding the specific needs of each market and tailoring their approach accordingly. It's a big challenge, but they seem to be approaching it strategically.
All this talk about expansion and future plans, it makes it easy to forget that Tarsons is dealing with some real challenges right now. How are they managing those growing pains, of the Ponchla plant expansion, while keeping their eye on the global prize?
It's a delicate balancing act, for sure. They're dealing with upfront costs, depreciation, and interest expenses, all of which are impacting their short-term profitability. But they've been transparent about these challenges, and they seem to have a plan to address them.
So they're acknowledging the bumps in the road, but they're confident they can overcome them. It's like they're saying, we know this journey won't be easy, but we're in it for the long haul.
Yeah, exactly. And, their track record suggests they have the resilience and the strategic thinking to navigate these challenges. They're focused on building a sustainable business for the long term, and that's a promising sign.
All this talk about long-term strategy makes me wonder, looking back at their recent performance, are there any specific details or hidden clues that reveal something about their overall approach and their potential for success?
That's a great question. Let's take a closer look at some of the details buried in their financial statements and investor presentations. After a quick break, there are some fascinating insights to uncover that shed light on their current state and strategy.
Okay, so we'll be back in a moment to unearth those hidden gems and see what they reveal about Tarson's journey. Stay with us. All right, so welcome back. We were getting ready to unearth those hidden clues in Tarson's financial performance. It's like we're putting our detective hats back on, ready to analyze all the evidence, right?
Exactly. One thing that really jumps out at me is the difference between their consolidated and standalone figures. Tarsons reports both standalone numbers, which just reflect their core operations in India, and then consolidated numbers, which include, their subsidiaries like Nurbay.
So we can compare those two sets of numbers and get a clear picture of how their acquisitions are impacting, the overall performance. That's pretty smart.
Right. For example, we see that their standalone gross profit margin was 71.2% in Q3, but their consolidated gross profit margin was a bit lower, at 65.4%.
Right, and that makes sense, given that Nurbay operates in a different market, right, with potentially different cost structures and pricing dynamics. So by bringing in Nurbay's numbers, it kind of pulls that overall margin down a bit.
Exactly. It's a good reminder that acquisitions can take time to fully integrate and optimize, but we also see that their consolidated EBITDA margin is actually higher than their standalone EBITDA margin, 38.3% compared to 36.7%.
That is interesting. Why would that be?
Well, it suggests that Nurbay might be operating at a higher EBITDA margin than Tarson's core business in India. It could be due to differences in, product mix, or pricing strategies, or even operating efficiencies.
It's so fascinating to see how these different pieces fit together. It's clear that, Nurbay is a really key part of their growth strategy, but it's going to take some time for the full impact of the acquisition to be reflected in those financials.
Absolutely. Acquisitions are complex, and it takes careful planning and execution to make them successful.
Earlier, we were discussing how the Ponchla plant was impacting their standalone PAT margin, which is currently around 10%. So how does that compare to their consolidated PAT margin?
Well, their consolidated PAT margin is actually a bit higher, coming in at 11.5% for Q3.
So even though the Ponchla plant expansion is, weighing on their standalone profitability in the short term, the positive contributions from their subsidiaries, including Nurbay, are helping to boost their overall net profit margin.
Right, exactly. It shows the importance of diversification. And having multiple revenue streams, it's like having a diversified investment portfolio. It helps to, mitigate risk and balance out those ups and downs.
It's all about spreading the risk, creating a more stable and sustainable business model. And speaking of sustainability, we talked about their debt levels earlier. So are they comfortable with their current debt load?
Well, they've been pretty transparent about their debt management strategy. Their consolidated net debt as of December 31st stood at 277.9 crores, which is, a significant sum. But they've assured investors that they're comfortable with their current leverage ratios.
Okay, so they're keeping a close eye on those debt levels, making sure they don't overextend themselves. That's good to hear.
It is, and they've also highlighted their strong cash flow generation as a key factor in their ability to, manage that debt.
It's been fascinating to go through these financial details and see how they reflect, Tarson's overall strategy. It's clear they're making some bold moves, but also being very careful to manage their finances and, those risks.
They're playing a long game, investing in their future, while navigating the complexities of the present. It's a journey that requires both ambition and prudence.
Well, I think this has been a really insightful deep dive into the world of Tarsons Products Limited. We've explored, their financial performance, their growth plans, and the challenges they're facing.
We've seen how they're leveraging their strengths and adapting to the demands of a dynamic global market.
And it's clear that, their story is just beginning. They're definitely a company to watch, and we'll be following their journey with great interest.
This deep dive has provided a glimpse into the world of a company that's not afraid to dream big and take risks. It's a reminder that success often requires a combination of bold action and careful planning.
That's all for this deep dive. Until next time, keep exploring, keep learning, and keep pushing the boundaries of what's possible.